Welcome to Pearson Bryson. My name is Conrad. Hello and welcome to the channel. If you're someone who wants to reduce your tax bill significantly or to even zero, you found the right channel. We don't endorse evading the IRS or committing any type of tax fraud. You pay your bills and be ethical, but there's legal ways you could dance with the tax code in a fashionable way. So let's get right into it. So I'm gonna give you the holy grail. It's gonna be 4 different tax codes that are 4 of my favorite, which is IRS Tax Code 162, IRS Tax Code 167, IRS Tax Code 179, and IRS Tax Code 482. My whiteboard of conviction is basically, I'm gonna leave this in the end of the video. I'm gonna leave a clear view of it. That way, if you wanna scrutinize it, you wanna go through it, you can totally do that. Always do your due diligence. Don't just listen to me or any other person on social media. Always fact check, go through the IRS tax code, make sure it's true, run it by your CPA, your tax strategist. Oftentimes, they might not even be aware of this, and you could be educating them too. It's all about being a think group. So please don't just take my word for it, do your own due diligence, but I'm gonna share a wonderful way that you can reduce your tax bill. Even if you're a physician, if you're a doctor, if you're a medical doctor, if you're an engineer, if you are someone who clocks in a 9 to 5, if you're an independent contractor, if you're a business owner, if you're a sole proprietor, again, doesn't matter where you are at in your life, the tax code is meant to be interpreted. You just have to have the right person point in the right direction. So I'm gonna share 4 of my favorite, and let's get right into it. So beyond that, I'm gonna also share this. So you're probably aware of how some people buy houses and property and they utilize it in reducing their tax bill by either renting it on Airbnb or renting it long-term. There's so many different strategies. This is completely different. This is through a company named Turo. You can actually rent your cars on Turo and you can start getting Turo tax codes that you probably aren't even aware of. You can also start your own independent rental car company outside of Turo, but recommended preferably Turo is usually the way to go because even if you have no experience, they give you leads, hot leads essentially. So all of us grew up understanding that cars are typically depreciating assets and houses are appreciating assets that go up in value. Cars are typically depreciating assets that go down. Butter typically, right? Did you know as long as you turn your depreciating asset, which is a vehicle, into a rental car for business, it becomes a depreciating asset because now it's earning income for you. And remember, since it depreciates anyway, and the IRS understands that, and most people understand that cars depreciate as soon as you buy it off and take it off the lot, that becomes a tax deduction. Remember, IRS tax code 167 allows you to depreciate your vehicle and get a deduction for it. So the car is already doing that naturally. It's a depreciating asset. It's harder to prove that with a house. It's an appreciating asset, right? But when it's a depreciating asset already, it's already easier. So that's less chance to audit. Not that auditing can't happen to you. You always want to document, keep all your receipts, etc., and make sure everything's ordinary and necessary in the pursuit of income. But the reality is this, though. The car is already a depreciating asset. So what you're doing is, since it's going to depreciate anyway, you're allowing it to depreciate on your tax bill. So now say you earned $100,000, say you earned $1 million, say you earned $2 million, say you earned $3 million. The reality is you can utilize the Turo business to depreciate and bring that income down to zero or bring it down further than what you would be paying. So pretty cool. So for example, you say you add a car to the Turo platform and it's operating as a business expense because now you have IRS tax code 162. So that's registration fees, that's going to be maintenance, car wash memberships, detailing the car, washing the car in general. If you pay employees or someone to take care of your car, to maintain the car, you can also pay management fees, etc., and get deductions for these. And essentially, these are Turo fees as well, Turo protection plans, Turo deductibles, anything that is a cost for that's ordinary and necessary in your business, you get as a deduction anyway. So you have that working for you, but it's also earning income for you. What truly bothers me is when people start trying to overspend money just to buy a truck, for example, that's over 6,000 pounds, just to get a tax deduction. That's cool, maybe once, maybe even twice. But what are you gonna do? Keep on buying more tanks, keep on buying more trucks, or buying assets that are over 6,000 pounds so you get a tax deduction? They're not making you money though. That's the problem. So the smart thing to do is by utilizing Turo, for example, these are cars that are being rented. It's no different than Airbnb. It's basically the Airbnb of cars. People fly into town, want to rent your car. Turo's a marketing company who gives you leads. That's where it merges. So the car's depreciating, so you're getting a reduction on your tax bill. You're earning income as well at the same time. So it's an appreciating asset now. And now you can further reduce your income. Say you're a doctor, say you're an attorney, say you're an engineer, or say it doesn't matter what your profession is. If you earn income as a W-2 wage earner, 9 to 5, and you work for an employer, or if you're your own business owner, if you have an LLC, if you pay yourself, doesn't matter. These are business expenses that you can reduce your income, and that way you pay little taxes or less taxes than you would pay if you didn't have a Turo business. Really unique way to look at this, and utilizing IRS Tax Code 162 really helps with that, while also earning you income. There's a lot of times people buy the G-Wagons, buy the Hummers, the big trucks, the tanks, just to write it off. But then what after that? You're gonna buy another jet, you're gonna buy another tank. That's cool, but now you're just kind of setting money on fire now. Unless you really just want to keep it for personal usage, but the reality is that it's not really making you money. It's a business asset they're using as a business expense, but this actually earns you money because it's being rented out. People are utilizing your car, they're depreciating, they're putting miles on the car. So now you actually can utilize this in such a way where your car's aging is being accelerated in such a fashion, you can actually get this back on IRS Tax Code 167. And then IRS Tax Code 179 allows you to depreciate the car the first year. There's rules around this though. You want to be careful. So for example, if the car is under 6,000 pounds, you can still depreciate the vehicle. And if it was over 6,000 pounds, you can still depreciate the vehicle, but it's just different rules. When it's over 6,000, you can write typically everything off in 1 year. When it's actually depreciating the cars under 6,000 pounds, you can actually depreciate it, but there's different ways you have to do it. You might want to apply bonus depreciation to it as well. That way you can write off more of the car in that first year. And then that's one of the best strategies, because now as long as you put the car into service that year, the car must be put in service that year, that taxable year you're claiming. You can't buy the car last year and put it in service last year and claim bonus depreciation this year. Bonus depreciation is meant to be able to be capitalized on the same tax year that it was put into service. So same thing, if you bought the car now and you want to put it in service next year, you can't get bonus depreciation this year. You have to get bonus depreciation, put the car into service that taxable year to claim it that same year, and then you can combine that with IRS Tax Code 167, for example. So now you're depreciating and everything, and then while also utilizing bonus depreciation, now you're getting the car deduction written off essentially, or reduce your tax bill. It gets a little complicated. I'm just trying to summarize and keep it simple, but really benefits you because IRS Tax Code 167 allows you to depreciate the vehicle so you can reduce your tax bill. IRS also Tax Code 179 allows you to do it in 1 year, and then there's also bonus depreciation. And then IRS Tax Code 482, which is the glue to all this, allows intercompany transactions. What that means, and that term's governed by the IRS, essentially means that you're able, for example, Conrad can own a car, and I can have an LLC, for example, run my Turo account, and I can lease the car to myself to rent it, or vice versa, and get a tax deduction. Or I can wash my cars, for example, that are leased, that are held by my LLC, and I can pay myself a fee, or vice versa. I could pay my LLC, for example, as someone for my family member. It could be a spouse, it could be a child, it could be a grandchild, it could be, as long as it's a related party, an LLC, an entity, as long as it has a different EIN or different social security number. It could be your spouse. It could be a great way to raise your kids and teach them responsibility as well, keep the money in the family. So instead of paying and sending the money to a third party or outsourced company, you can actually keep it in source and keep it to yourself. That way you keep more money in the family, keep it to yourself, but you still get the same tax deductions as if you were paying someone that you're not related to. IRS Tax Code 482 does is you just have to properly document and make sure to keep all your records. That way you can show that you're not double dipping in an illegal fashion, but you can double dip in a legal fashion as long as you keep the proper documents. You own the company LLC, for example, or say it's your spouse, say you're a doctor, say you're too busy to do this, your wife can run the business, or your grandchild can run the business, or your child, your sibling, your brother, your sister can also run the business. And what they do essentially is you pay them to clean the cars instead of paying outsource. That way you keep the money inside, or you pay your own LLC and that you're operating through, and then you're paying yourself essentially, but you're operating as an LLC compared with your sole proprietor. It gets a little tricky, but the point is it is legal. I left the article below so you can do your own due diligence. Run this by your CPA, run this by your tax strategist, not your tax strategist, but this is true. And you can read the articles in the description below. And there are rules to all of this, but it's fairly simple. Keep documentation and show that it's ethical. So this allows you to pay yourself And so instead of sending money to pay for to get your car clean, paying to have your car delivered, etc., what you're doing essentially is you're paying your family or you're paying yourself through your entity, your LLC now, and keeping the money in one account, or keeping it in one party, essentially, not one account, one party. So that way you're not just sending money out. You're keeping more of your bucks. You're able to give yourself a discount, but you can also use those same deductions yourself. So you're basically double dipping. So really understand that. The beautiful part about this in cars is that we all understand houses on average typically appreciate. Cars typically depreciate, but when you rent the cars, it becomes an appreciating asset because now it's earning income from you. And also at the same time, it's also allowing you to utilize the depreciating aspect of a vehicle to bring your income down to zero. That way you're taxed at a zero rate. So for example, say you got a $10,000 deduction from a car, right? And say you earned $100,000, right? Now, instead of paying taxes on $100,000, you're paying taxes on $90,000. This is how you reduce your income. So you go to a lesser brackets. So you pay less taxes legally though. That's how you do it. It's really, really easy to do that. Again, run it by your CPA. Not all tax strategists or CPAs might know this strategy. It is fairly new, fairly coined, but it is true. And I left all the documents in the description below. But the point is, educate yourself. And also, I'm gonna give you another tidbit of information. Think of it this way. On average, and do your own research too, don't just take my word for it, but on average, homes are rented anywhere in like it could be a condo, it could be a home, from $1,600, typically on the low end in the United States, to $3,000. Prices vary depending on one side of the nation might charge an exorbitant rate and one might be a lot cheaper. There's a lot of reasons for that, but on average, the range is basically $1,600 to about $3,000. And typically, remember that the average home in America could be anywhere from the range, 200,000 on the very low end, to maybe up to maybe 1.4 to 2 million, places like California, New York, etc. It could be fairly high. So what you have to understand is if those are the averages and the average rents are $1,600 to $3,000 and average house prices in America are $200,000 to 1.5, 1.4, or $2 million for homes, this simply means that you get a car that's worth $7,000 to $10,000 that can earn you $1,600 per month. So you're earning more with a car that is a depreciating asset, but that's earning income. It's movable. It's not just an adjacent property that's stuck to the land. You can actually rent this. You can sell it. Yep, it moves, and it's lower barrier to entry. Typically, people that have a home that's worth $200,000 or more are locked into a 30-year mortgage. Typically, so if you're locked into a 30-year mortgage, which is fine, real estate is amazing, but that's the reality, though. Even if you got a car for $200,000, which I am not endorsing getting a car for $200,000, let's say a house is worth $200,000. That $200,000 car on Turo will earn you a whole lot more typically than a $1,600 or $3,000. You'll earn close to probably $8,000, $10,000, even more than that with that type of car. For example, the purpose of what I'm saying is not to buy $200,000 car. It's just to show you that it's such a low barrier to entry because cars cost a lot less than homes, but grant you similar or even more income. You get a car that's a few years old, worth $7,000 to $10,000, that will make you more than $1,600 to $3,000 per month. A fact. And you can do your own due diligence by going to Turo and checking it out through the Turo Calculator. But the point is that you can figure out how to actually earn more money with cars and homes. If you're doing homes anyway, why not add cars as well? I mean, you don't have to pick one or the other. If you already have a home, great. For those that don't have a home, start considering cars and then earn income. Then you can start getting your home. As you're starting to earn a lot of income with cars, you can transition to homes. If you already have homes or a home that you're renting, then why not add cars to your fleet? Why not add cars to actually earn more income? Again, do your own due diligence. Don't just take my word for it. Scrutinize it as much as possible and fact check. Don't just believe anyone on social media. Don't just take my word for it. I am telling you the truth, but you don't know me and I don't know you. But I'm sharing a strategy with you that a lot of our clients have actually been utilizing. It's the Turo tax code strategy. Super simple. They add a car on the Turo platform. As soon as they do it, automatically becomes a business asset. It's a depreciating asset. They already have a tax deduction. Try to do their best to depreciate the same first year, get bonus depreciation on top of that. Start a management company where now they can pay a management fee to their spouse, to their wife, to their husband, to their grandchild, teach them a little bit about responsibility and budgeting. And now they get that as a tax deduction as well. This is a beautiful way to actually bring down your tax code, even for those that might be too busy. Maybe you're a professional, maybe you're an entrepreneur, your hands are in other ways of earning income. But but maybe you have a spouse at home, a family member that you can do business with, where you trust them, and this is a way to reduce your tax bill while also helping them out. It gets really unique. But anyways, welcome to the channel. Welcome to Pearson Bryson. This is what we do here. We invest. We also talk business and share tax strategies. Again, I am not your CPA. Find your CPA and fact check everything I said to make sure it's correct, which it is. Like, subscribe, share. Ciao.